But we begin with this market sell-off more broadly as the rebound attempt this week has failed.
Hedge fund managers are really pulling back. I think the thing that's interesting is they came into the last couple of weeks with low conviction, trying to get a feel as to what direction policy would go.
But this is very exciting. So we're signing a executive order today that's going to lead to tremendous growth in the automobile industry. Tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff.
And with that, Donald Trump made his most aggressive trade move so far, slapping tariffs on all cars coming into America and all car parts. A move that will significantly raise the cost of vehicles being imported to the US from around the world.
Japan's Toyota. In Europe, we're looking at Mercedes-Benz and Porsche shares down by around 3 to 4%. The biggest auto mover, though, at this hour is General Motors, down nearly 9%.
Well, buckle up as Liberation Day is just a few days away. And the markets are not liking the uncertainty as trade wars are kicking off. We've watched the S&P 500 tumble over 6% as the trade tensions are now picking up and tariffs are going in place. With technology taking on the brunt of this, with the triple Qs down over 8% year to date. ARK Invest's Kathy Wood believes small businesses are down, but they are not out. And Tom Lee remains very optimistic about a V-shaped recovery, as the bull case is that there's a lot of dry powder on the sidelines. And when we look year to date, it's been a brutal year, a hard year to navigate for sure, but I do believe this is value investors' dream here. Uncertainty is definitely creating opportunity. We're up only 2% year to date, but major indices are down. And most stocks are down 20-30%, especially when we talk about technology and small caps. I do think it could get a little bit worse before it gets better, as most of you know, but I also think this is the time to start deploying capital, and I am sitting on a lot of capital. Not only am I sitting on a lot of capital, I am starting a part-time job where 100% of my check is just going right into an index, set and forget it, because I do believe this will be one of the better buying opportunities that we're going to see in a long time. When we take a look at what happened to a name like Google, down nearly 5% in one day, down 18% year to date. These types of names are starting to approach bear market territory. How much more downside risk is there? Really hard to tell because we can get hysteria in this market. But I tend to think we are starting to reach value territory on a lot of these names where it's starting to make sense to dip your toe in because maybe Tom Lee's right. Maybe we get a V-shaped recovery. Maybe we get a resolution when it comes to tariffs. But I tend to think a lot of this rhetoric could end up extending a lot longer than we all anticipated. So I don't think you personally need to rush. Now, of course, this is not financial advice. This is just what I am personally doing. But a name like Google was trading for over $200 a share not that long ago. So if we take it from the highs and recent lows here, we're down nearly 25% in just about a month, which is crazy. Now, personally, how I'm approaching this is starting to pick off names maybe like Google here really soon, or possibly Amazon, which is also down over 20% from recent highs. These are two names to me that are definitely getting pretty interesting at these levels. And when I look at how the broader ETFs are diversified, very, very overweight technology, I tend to think that you want more emerging market exposure here, a little bit of small cap names, and you want to pick high-end quality tech. That's personally where I think the biggest value is. I'm looking at some of these small cap names that are tremendously undervalued. I'm looking at names like Google and Amazon that are definitely looking like they're on sale. And then when we take a look at emerging markets and we know US GDP is slowing down, I tend to think things like India, where they're having GDP growth of 5 and 6%, tend to be a better long-term buying opportunity, especially if we're looking 3 to 5 years out. Now, over the last few years, we had fiscal spending through the roof, and that seems to be slowing down while we have job cuts and Doge making some eliminations here on some serious programs. We're also watching names like Cleveland Cliff starting to make layoffs as well. And the other thing we have to think about, if businesses are holding steady, meaning they don't know what's going to happen in the future, so they're not going to hire, they're not going to spend, this could leave a kink in the economy going forward where there's going to be a lack of spending in the near future, which could cause GDP to shrink even more. We have names like UPS and FedEx that have been in a consistent 3-year downtrend and maybe finding a bottom here soon. Now, I tend to think that these names could bottom as we're getting a confirmed recession and could be a flock to safety, and this would be the opportunity to buy them for the rebound. of economic activity expanding once again. But I tend to think these are good bellwethers to what exactly is going on in the economy, and it was pretty bleak with FedEx last earnings. Now we take a look at the S&P 500, and to me, it does look like it's rolling over here and finding some support, as this was a key area that I thought we could hold for an extended period of time and maybe bounce off of these levels. Now with the tariffs coming through, it's going to be interesting to see what happens. On this chart, this is a 3-year weekly chart. And now the thing I want to point out is when we look at the yearly chart here, we've traded well above the 200-day moving average for an extended period of time. And this is the first breakdown that we've seen in some time. Went up to retest the 200-day moving average, have gotten rejected off of that, and we're at that key trend line that I have drawn here, to where if we do break below this, I do think we can test this yellow trend line that's been in place for the last 5 years. Now, the damage that I believe is getting done is if we don't get a catalyst anytime soon here, I tend to think that we could be looking at a downward market going forward for an extended period of time here, which would line up with my thesis of a possible recession heading into the end of this year. Now, just to make you guys aware, the S&P 500 is only down around 8% from recent highs, but we can still see we're trading at 24 times earnings, and a lot of the names that are made up of the S&P 500 are down 20 and 30%, as we showed you with Google, Amazon, and even Nvidia. Even if we got to a normal multiple, how much more downside risk could we be thinking for those names? Just remember, when we think about the historical PE ratio of the S&P 500, it can absolutely go in either or direction pretty hard depending on the catalyst moving the markets. I want you guys to err on caution, not try to time this, but slowly enter into high quality names, because I do think they will pay dividends going forward. And we're going to be following our progress here very, very soon, as we're going to start putting some more money to work here very, very soon. And as always, ladies and gentlemen, appreciate your time, and we will see you all in the next